Hello, good morning, everyone. Thank you very much, GTR, for organizing this conference and for inviting us all to join this panel on risk management and asset diversification. Let's just check if everything is working well. So we all know that last year's, just before 2025, brought really record profits for the traders of different commodities. And now these traders are looking into hedging their optionality and diversifying into other commodities like metals or into the energy asset infrastructure. And it's going to be very interesting to discuss it today. And more interesting, we have here representatives of both lenders and borrowers and different parts of the world, and we can really have a global picture and a very interesting picture. So I'd like to introduce myself and then ask our speakers to also introduce themselves. My name is Mariana Stober. And I'm a lawyer. I work for SEM, and I'm also a president of Vista Switzerland, which is an NGO promoting women leadership in the shipping and trading. Over to you, Alexander.
I'm Alexander Lukin. I'm CFO of D-Trading. D-Trading is a trading arm of a Ukrainian energy concern called DTEC.
Tony Nanes, global head of global trade and working capital solutions, where our commodity trade finance business is.
My name is Sukomi Oyemi, Managing Director of Sombe Global Concept. We trade cocoa, soya, sesame. Thank you.
Okay, thank you. So let's start with the big picture first. And I would like to ask Tony first, and I'll just shoot you a couple of questions, Tony, just to start and warm up our discussion. So how do you see main changes in the corporate diversification strategy over the last few years as a lender, obviously, a major lender in the world?
Sure. No, thank you for that question. I would say that for the most part, when you look at asset diversification among the major commodity traders, especially after the last 5 years of robust profits and what have you. I still think that there's three sort of strategies that continues to be front and center. We look at vertical integration, right? Whether it's downstream, midstream, or upstream assets. We see in all public information in terms of looking at the commodity traders tapping into or taking opportunities of asset diversification or disposal, in particular in the midstream, and now we see more and more on the downstream around refineries and getting to the final end user for petrol stations. So that's definitely one strategy that continues to be front and center. The other one is geographical diversification, new markets, right? Africa in particular, I heard from the previous panel, sort of more and more interest, rightfully so, to look at, Africa as, the 50 plus countries or more that are there, both as a point of resourcing of commodities across, energy, ag, and metals. But even more important is demand, right? I mean, if you look at a country like Nigeria, I'm probably stating the obvious to a lot of people here, about to hit 300 million people, right? So that requires a lot of consumption of commodities. Last but not least, I would sort of add another diversification, which is geopolitical diversification, geographical diversification. And that certainly is very important these days. In light of disruptions in supply chain driven by geopolitical sort of announcements and movements. So therefore, I see the commodity traders really looking to see how do I hedge that sort of geopolitical sort of changes that are coming fast, right? So I would say those continue to be the three sort of main diversification strategies. I was just in the APIC in Singapore a couple of weeks ago, and to those 3 points that I just mentioned, the talk of the town was not about energy really, it was about metals, right? With the recent announcements of some of the majors going into the metals markets or re-entering the metals markets. That definitely has been the top this point of discussion. The other is new markets, which is all around power. As more countries become deregulated, as we've seen in the U.S. and other places in Europe, more and more power trading coming into sort of the trading strategies of our commodity clients. So, when you see that, again, going back to these 3 strategies that have always been there, but I just think now, given the last 5 years and the stronger balance sheets and the willingness to look at different types of asset diversification, it'll become a little bit more and more stronger going forward.
Yeah, thank you very much. That's interesting, and as you said, a lot of things are quite obvious. Now I'm going to ask you a question, and then I will ask 2 other gentlemen the same question. So let's look at the long-term financing today and the evolving relationship between the banks and the borrowers in view of different need for credit, structured trade finance, and just changing world. How can you comment on that from the bank's perspective? And then we will look at the borrower's perspective.
I guess I'll open it up and say that really looking at it from a total financing market perspective, right? First and foremost, we've seen quite a bit of more engagement and meaningful transactions being supported by the export credit agencies, right, globally. And we saw that as a result of COVID, and then followed by the Russian-Ukrainian situation, where it was important for these export credit agencies to provide support in order to assure security, right, security of commodities. And obviously it started with energy security. And we see the Export-Import Bank of the US, which traditionally has not really been involved in supporting that much more commodities, see them really double down on supporting LNG flows out of the US. So I think the export credit agencies are definitely playing a very big role in terms of providing that necessary long-term financing for some of these project and asset diversification. Classical instruments of prepays are back in vogue. The market has seen recently 7-year prepays in energy, 5 years prepays in iron ore. So certainly, again, related to sort of offtake agreements, but quasi-project related. And look, I say last but not least, kind of the early resurgence of private placement and private credit, mainly in private credit, with the sort of growth in that market as alternative finance solution and liquidity has come into the space, chasing deals, right, and chasing deals. So I think the private credit market is one to kind of watch as we go forward. Interesting.
And now, Olasunkanmi, do you want to comment on your priorities as the borrower? How do you want to, what's important for you when you are building long-term strategy with the banks?
Yeah, I think the first thing we've seen in business is that the banks sort of, the appetite of the bank to take risks in Africa, where we do most of our trades. So to enable the bank to do that, we need to do extra sort of things like ensuring our supply base with the credit insurance scheme to prevent default. That's the sort of thing we do. So it's mainly about the appetite of the banks. Aside that, we've seen issues of African banks not being able to offer structured trade products like hedging of the market risks, margin call lines, variation lines. So what we've done is to diversify geography, setting up businesses outside Africa to the risks jurisdiction issue, legal issues, and talent issues also to enable banks finance. You could know the sourcing, but the bank wants to be sure you have the right people helping with the sales and the agent. So even on the geography part, there are different skill sets. Africa, you can be good with sourcing. You might not be good with agent. You might not be good with the final sales to the end users. So how we've been able to manage this to ensure the bank has the right appetite to do these deals is putting these structures in place. And I think the most important thing is building long-term with the financial institutions. Once you continue to repay, you get to continue to build relationships, and it takes time. So looking long-term, repaying, integrity is most important for the banks, not doing double financing, and ensuring you are able to do it right with the right people. I think once the bank sees that, the appetite starts to come up and they go the long haul with you. And one of the ways we've tried to also diversify this sort of delays you can get with banks is to look at alternative lenders who know you, and like traders, big traders you work with who could say, oh, I could on-lend to you since the bank is not going to be fast. I know you, I would use my perception of you to help finance your flow. There might be a bit of issues, you try to resolve it together again, and it's always resolved. Once you pay back, you do more. So those are the ways, and I think the most important thing is creating the structure from the ground up with the right talent. It's what really interests the lenders, just knowing that people know what they are doing. I think that's it.
Yeah. Thank you. And I see that Tony was really agreeing on the section when you mentioned to be repaid. I think that banks like to be repaid.
No, absolutely. It echoes with a lot of sort of the way we look at things too, right?
Yeah.
And I think what resonates, and we'll talk about this a little bit later, as it relates to AI, right? I mean, talent, right, and people, and there's no replacing that. So happy to hear that that's a big focus for you in terms of getting the right people to do the right thing for you.
Alexander, over to you. What are your key priorities when you are looking for the long-term financing and relationships with the banks?
No, for us, actually, the relationship with banks is of strategic importance because we are, as a Ukrainian trader, we have started our expansion or strategy to become an international company 6 months before the war started. And actually, what was kind of nice slides prepared by very expensive strategy consultants all of a sudden became our survival strategy. So we actually had physically moved people outside of Ukraine to manage our operational risk, right? To make sure that our company operates. And we actually managed in the 2022 not only survive, but it was one of the best years for us, thanks to a very high volatility. And for us, it was clear kind of confirmation that our strategy was right, because Ukraine in reality still remains the largest energy market in Eastern Europe, and whatever happens in Ukraine actually has a strong impact on neighboring countries. And our idea was actually quite simple. We look at the countries which are directly or indirectly impacted by Ukraine, and this is our target markets. What also helps, and this is also relates to banks, that this is over 20 markets, which some of them are quite small, right? So not only there is a low competition from other international traders, but also we can see that working with banks, in reality, you can have a large international bank which is present in multiple countries in the region. But in reality, you still have to deal with local regulation. And in reality, this is kind of a confederation of local banks that work under one name. And for us, obviously, to finance the expansion out of Ukraine with Ukrainian cost of capital is prohibitively expensive. So building relationship with banks is a key part of us being successful. We managed relatively quickly establish that our idea that, you know, we have experience from Ukraine, we have understanding of energy market. These markets, you know, 20 markets where we built our presence are not efficient, so we started making money right away. But for banks, you know, only showing, look, you know, we know how to make money is not enough, right? I think the big change since, you know, last 5 years because of the regulatory pressure, capital constraints, that banks don't rely simply on the balance sheet. They still like to have, you know, at least 500 million or better couple of billions on the balance sheet to start talk to the clients. So for smaller companies, it's a bit more difficult. But at the same time, banks want to see the flow, right? They want to have in the business something that they can really, you know, touch. This is receivable, this is inventory, these are the cargoes on the water, that can also be assets, right? And this is, I think, also why other commodity traders invest in assets, being physical assets or soft assets like contracts, you know, going, for example, into the retail space. And for us, it was quite clear we need to develop a relationship with banks built around the trade flows. So I think the key for us is to build a business which is understandable for banks, business that has elements that bank can use as a collateral. So this is a receivable, these are the inventories, this is a long-term supply contracts. And also for us, what we realize is quite important, talking to kind of the same bank but in different countries, you have to really build the trust and lead the dialogue. Because also I think for banks, the challenge in Eastern Europe is that, you know, you have all these instruments in Western Europe, but sometimes you have multiple jurisdictions and those jurisdictions are not up to task to deal with repo or transactions or, for example, with financing of storages. So building dialogue with the banks, showing that business is developing, also paying money back, I think it's important. This is how to proceed. So we see the cooperation with the banks as a kind of two-way road where we educate both our sides and developing our business along the lines that banks actually understand.
Yeah, very, very good. And Tony, if you would like to comment, feel free to do that. And it's okay if you guys don't agree among each other. That's also fine.
No, it's not a function of agreeing or not agreeing. Look, what I can say about, we have seen, obviously, over the last 5 years, in particular the last 5 years, the growth of the market, right, and the profits among not just the majors, but also the smaller, call them smaller commodity traders. That's on the back of a lot of the volatility and the opportunity created where people were in the right place, the right time, infrastructure, people, risk management tools, and understanding of the supply chain. What I would say is that we are now entering a new stage, right? A new order in terms of less volatility, less the profitability is certainly being compressed, if you will, compared to the last 3 years. So from our point of view, more than ever, and I've been doing commodity trade finance for like 25 years, just 2 years at Citi. Citi as a standalone commodity trade finance unit has been here for about 15 years plus. And we've seen cycles, right? So I think at this point in time, when we look at going forward in terms of how we continue to support the commodity supply chain, we need to put on a little bit extra of a risk hat, if you will, because, a lot of, new uncertainties are in the horizon. And, on the back of, again, phenomenal 3 to 4 years as we enter kind of like the new normal. So from that point of view, I think, both bankers and certainly new players in the market have to continue to kind of develop that relationship and see how they can support each other, right?
Yeah, I know in our notes we agreed that we would also like to talk about working capital optimization and credit risk management. So the tools you use, the strategies you use, both the borrowers and the banks, and exchange your views on that. Would you like to start, Lasum Kanmi?
What we do around that is inventory finance. We try to do financing against warehouse receipt. And we try to optimize by discounting receivables. And also, we try to do structured trades, like financing of an export contract with assigned receivables. Before you can do that, also, the bank needs to trust you to a level because there's going to be a performance risk. So there has to be the track record of performance with certain names that makes the bank comfortable to do that. And there's the borrowing base loan against certain assets that you keep doing. So that's one of the things we do to optimize the working capital. And
And what are your main challenges in this?
The main challenge involves, like for us, we trade mainly in Africa. Then we started a trade house outside Africa in London. And the biggest challenge we've seen in Africa is the banks not understanding what structured trade is. A lot of difficulty getting onboarded with the international banks. And again, it's a whole lot of challenges in terms of the onboarding. Then you need to set up office in different jurisdictions to be able to be banked by some international banks, no matter what your equity looks like. And again, another challenge is you could have a 50 million equity and the bank says, I want 100 million equity before I can finance you. So those are some of the challenges. And and again, talent issues. You could even have the lines in some part of Africa and you don't have the talent to optimize the working capital and to make use of it the right way, especially in the hedging part of it. If you don't have the right risk management, then you tend to lose a whole lot of money, even if you have the cash sitting with you. So the talent part goes hand in hand with the trade for effective optimization. Yeah.
Very good. Thank you. And now, Alexander, what are your views on the same topic from the Eastern European perspective, working capital and credit?
First of all, credit is important, right? If you want to pay back banks the money, we need to collect them from our counterparts. And for us, again, a big chunk of our business in Ukraine, and we are diversifying in Europe, but obviously from the point of view of credit management, we have built quite a lot of capabilities in Ukraine with companies which are not, by definition, are not very good credit. So we have, we are working on the prepayment structure, we are trying to work with credit insurance. So I think for us, credit risk management is an important part of our risk management suite, right? And capabilities that we have developed in Ukraine, we are successfully applying in Eastern Europe. The issue with credit risk is actually more, again, on the side of the banks because, if you're trading with major German utility companies, nobody has an issue with the credit risk. But if you're trading with, local utility companies from Slovenia or Montenegro, then this is something which also, not only we need to understand, but we need to communicate to the banks why we believe those receivables are of the high value. From the point of view of working capital management, for us, again, the key is kind of twofold. First, we need to make sure that the liquidity is available for our traders, and as you know, for trading companies, it's not only breach the gap between receivable and payables. We need to have quite a lot of funds in collateral form, right? Which we pledge with exchanges or with brokers. And here comes the second kind of challenge that we have, that we need to ensure that we get, the best conditions for the money we put with other people. So we want to have a good rate of return. So we want to find a way where instead of providing cash, we can provide securities, where we can earn additional income. And we're obviously working very hard on establishing our, so to say, pedigree, not only vis-a-vis the banks, but also vis-a-vis the counterparts. Because in the end of the day, open credit is a significant source of working capital for us, right? So for us, it's basically daily job to ensure the money is there and they're cheap.
You want both the money and cheap, so...
I want it also fast.
No, look, what I would say is, clearly, from a working capital perspective, certainly there are different avenues or sources of liquidity for working capital, obviously depending on your strategy and the alignment with those particular lenders. And, it's interesting because what we've seen as of late is even more liquidity coming into the market, right? We see, this is, I think, the largest GTR Commodities conference, and you see banks from the Gulf region, you see some of the Spanish banks coming back into the space. So it's really encouraging to see additional liquidity coming into the commodity trade finance space. And hopefully that will sort of trigger into sort of new market participants, but more importantly, new markets, geographical markets that are coming into play. At the end of the day, when we talk about, again, to just really emphasize where I think a lot of lenders are today in terms of looking at risk in light of where we are in the cycle right now after the last 3 to 5 years. Let's not kid ourselves. There's been some hiccups along the way, right, in terms of, fraud. And therefore, more and more, that's really kind of something that, in banks' risk management committees, continue to point to some of these very historical cases of fraud. Nothing mitigates fraud, I think that for sure, but I think banks, in particular, the larger banks, have to kind of really talk to the risk management committees and kind of explain what happened there and why it's not going to happen with the clients that they continue to serve. And we'll talk a little bit more about risk management, and not to kind of go a little bit forward, but these are mainly private companies, right? And it's very obvious that I say the following: it's about the people, right? And you don't bank the companies per se. You bank the people who founded the companies. You bank the CFO, some of them that are ex-bankers, and you have a relationship and credibility with, and that's going to become even more and more important as we go forward and expanding, liquidity into, new market entrants. So again, from a risk management perspective, it's really about who you're banking and the people in those companies.
That's a very interesting comment, that you see through the company and you see the people. That's very interesting, almost HR comment, I would say.
No, I'm not talking from an HR perspective.
No,
I'm
I
talking
get
about
it.
the expertise in the market and, the credibility of individuals. Again, how long they've been in the game, how well do they know their supply chain, have they been around for when things get a little bumpy, right? I think that, that experience, it's not just about the last 3 to 5 years. It's about the last, modern commodity trade financing. I see JF is over there, was 30 years old. I mean, it's really Mark Rich going forward, right? So it's really a relatively new industry, right, in the great scheme of things. So it is about people and so having that trust in people that you are lending money to.
And Tony, now continuing with you, from your perspective, or from Citi's perspective, what financing strategies do the traders need to go forward in order to finance themselves, in order to finance their new diversification strategies and new plans? What strategy you would like to see on your desk in order to approve the client?
Yeah, look, again, I mentioned, by far what we are very keen and interested in continue to supporting, it's all around power trading. I think it's clear that as we see the development of power trading in the US, Europe, and other markets, as they become unregulated, commodity traders playing a very significant role in assuring that there's, reliable, consistent power that's being fed into the grid. And so that's by far, I think, the most important sort of commodity that's definitely we've seen growing and growing quite aggressively. And that ties back to metals too, right? I mean, there's a reason why the majors are getting into metals again, because you cannot support the growth of power around data centers and AI and population growth if you don't have, the grids, right? And the grids require a lot of copper, a lot of Ali for the poles, a lot of cobalt and lithiums for battery storage farms. So those two things, power and metals, clearly are fully aligned and together as a bit of a diversification strategy or just a growth strategy. So we are very supportive and looking to see how we can continue to work on developing and helping our clients sort of grow in the power and the metal space, and obviously the other commodities as well, soft commodities and what have you.
Yeah, I actually wanted you to comment a bit on the soft commodities, because here we have more energy panel, but we have a lot of people from the ag sector on the in the room. What's your view on the soft commodities? You are still interested?
I'm very interested in food security, yes. With growing populations, climate change or whatever you want to call it these days, having reliable food supply chains is more and more important. In particular, now that we see, some geopolitical sort of movements that basically have become, challenging in moving commodities and agri from one location to the other because it's just more expensive and what have you for tariffs and other reasons. I think, for sure, we have seen, continued dominance, obviously, on the food and ag from the ABCDs, right? But, there are so many other critical players that are supporting, soft commodities, whether it's sugar or coffee or soybeans and grains. So that is certainly something that we do finance and support, not only on the commodity trader side, but obviously on our global trade finance business. We are very active across all these countries, about 90 countries that we're in supporting agriculture and food security.
Thank you. I'd like to come back to the strategies and financing your strategies from the borrower's perspective. Alexander, you have mentioned that for D-trading, diversification out of Ukraine is one of the key priorities. So how are you approaching this priority from the pure financing perspective?
You're absolutely correct. I mean, for us, diversification out of Ukraine is of strategic importance because we already largest energy trader in Ukraine, and we obviously will defend our market, you know. But for us, it's important, you know, to develop and establish ourselves in Eastern Europe. As I said, we have presence in over 20 markets. We are trading on 13 exchanges, and we see already that having this infrastructure in place is already of the value. On the power side, we basically want to build, you know, full value chains, having own sourcing and having own supply. I think power is, we also believe this is an important market, and here the capabilities and experience play a very important role. I mean, we know how to operate assets in Ukraine, and our mother company is also investing in assets in Europe. I mean, we have already operating renewable assets in Romania. We are also investing in, we already have online 200 megawatt battery in Ukraine. We are working on the project of 120 megawatt in Poland. And I think the experience and understanding how the power markets work, how you manage portfolio of renewables and traditional assets, how the battery plays, investment into the prediction models, this is the skill set that we already have and we're going to develop further. And in Eastern Europe, this will play even more important role because as we started, there is a very fragmented market, right? You have 20 markets or different regimes, et cetera, et cetera. Same on the gas side. On the gas side, because of the absence of Russian gas, if you look at the forecast, right, Eastern Europe and Ukraine is a huge gas sink. Right, you have to supply. One of the sources of supply is going to be LNG. We have already brought LNG cargo to Eastern Europe. We'll continue to develop this capability on FOB basis going forward. And actually, this strategy of kind of, you know, having own sourcing, having clients to whom you supply, managing assets in the middle, right, is actually what banks want, right? They want to have long-term contracts where you buy. They want to have understanding where you store your energy. They want to have the assets that you manage, and they want to have, you know, clients who is paying for this. So actually, we are developing this strategy with a view how we're going to explain bankers what we do, and how we're going to get the working capital we need to develop this strategy. So I think this is kind of in a nutshell what we are trying to do.
I see we are running a little bit of time and we still want to have time for questions. So maybe we can move to our last topic. It's about automation and AI. So GTR specifically wanted us to touch on that, and we had a very interesting exchange in our prep call. Everybody was smiling and saying, yes, I have a lot of experience, and I will think what I can say, what I can share at the conference. So, gentlemen, would you like to share your views on the AI automation? How do you feel about it from your perspective, borrower, lender, user, and what's the future?
For me and our business, we see the AI automation process as a tool to further streamline operations from procurement to being able to predict patterns and the right analytics, and it just helps streamline things in a more efficient way. That's why we are embracing it, and we would keep embracing it. Yeah.
Yeah, look, I mean, for us, AI is a game changer, right, in many ways. As you can imagine, a bank like ours, we have a lot of data in terms of data of payments, data of flows that we finance, you know, and then sort of pair that together with, you know, our internal policies of risk management and credit approval. So AI tools are already embedded into our processes in terms of looking at how we can support our clients and being really smart and quick about looking at those data sets and sort of making us help us make decisions a little bit quicker. We have already sort of across the globe had many sort of training sessions and across all types of businesses in terms of the adaptation of AI. When it comes to the commodity trading space, again, one comment that I heard from one of the major commodity traders is, yes, adaptation of AI, from big picture down to like day to day. One story was, it takes me, a trader walks in the morning, it takes them about an hour to get its, 15 screens up and running, all the data points that they kind of want to look at to start their trading day. They build an AI Argo that basically does it all for them, and they're up and running in 15 minutes versus 1 hour, right? And it sounds like, a very small little thing, but if you think about that, multiply that across the number of traders in a particular shop, I think that becomes even more powerful, right? So yeah, from a micro perspective and also from a macro perspective, AI is here to stay, and it's a very powerful tool.
No, I think on my side, we are kind of a strange animal because on one hand we are a major company in Ukraine, and on the other hand we are a startup in Eastern Europe. And as a startup, there is a lot of things we need to do ourselves. And on the AI side, yeah, I mean, we have quite a lot of investment on analytical and trading side, but who am I to say what exactly they are doing? But I think on the finance side, very clearly I can say that we look at the AI as actually a tool that we want to use every day. And actually, I'm now talking, when I'm talking, and recently we were hiring a person, I basically said, look, actually you are probably the last junior we're going to hire because I want you to teach, AI the job that you do, and we don't want to hire any more juniors. It's simple as that, right? It has already capability to do junior job. And the way things develop, right, we are experiencing already beginning of exponential growth. So effectively, my view is that we are actually forcing people, I mean, not forcing, incentivizing people in the team to use AI in their current task, right, to train prompts. So instead of checking presentation, you develop prompt that does that. We look at the processes, and if you have, let's say, a regular email that you are sending and collecting data for preparing financial forecasts, think about how to use AI to do that. So I think, and I see that people actually started using this, that it becomes a daily tool which would help us on HR cost. I mean, it sounds brutal, but I think, if you're right now starting a career, junior jobs are going to go away. So from my perspective, I think it's not the nice fate. It's something that, if you don't do this, your cost structure is going to kill you.
Any comments from anyone else, or any comments from anybody in the room? Or maybe any questions? It would be nice to finish on a more positive note. Oh, there is a question on the screen. Can anyone read it, please? Because I don't see it.
You need the AI to summarize this question, I think.
Basically, the question's about how commodity majors are evolving their risk management frameworks to balance asset diversification, exposure to emerging markets, innovative strategies deployed to be more competitive, mitigating price. Yeah, it sounds like an AI response, if you ask me. But look, I mean, I think we covered a lot of this, right? I mean, I think that, again, from a risk management perspective, more of a personal opinion, I guess, is that, we're entering a new stage, right? after 3 to 5 years of really amazing growth and associated with the volatility that caused that growth, we're entering still a environment where, you know, price volatility, geopolitical, supply chain risk, they still remain, no question about it. And, you know, certainly I think the risk management frameworks that, you know, whether it's the clients or the banks, that, you know, are looking to align themselves to that new norm, if you will. And it's just a constant, continuous readjustment of that framework, right? But again, I think at the end of the day, it comes back to, you know, the role that, you know, that particular commodity trade finance company has played in a particular market historically, and how they're going to adapt those strategies in new markets, as we had just discussed, you know, whether it's power, whether it's LNG flows. All of these have different sort of parameters that need to be considered in order to, you know, be successful and be able to manage the risk associated with it, and obviously have a successful outcome from a profitability point of view. But
Thank you very much. Thank you. And if there are no more questions, we will be finishing just on time, like a Swiss watch. Thank you very much, and enjoy the conference. Oh, sorry.
I just wanted to push something and say something about what Tony said about commodities prices going up, not available in some places, climate change, you know. To me, because I'm practically on the ground traded out of Africa, I think there's a great mismatch between working capital provided to traders and even to the exporters out of Africa. But there's what is causing the deficit now. For me, it's not necessarily the climate change. It's because the farmers, the producers, who are the bedrock of commodities, soft commodities, they have been left without financing in Africa. Even small-scale farmers cannot scale up to commercial-sized farms. This is the key issue causing the decline. So that mismatch, the traders have all the money to build processing plants, to buy the crops, but the capacity of the producers keep declining year on year. They don't have access to technology, education, logistics, market access, even financing structures to increase their farmland, to further increase production. So without finding ways to de-risk them and ensure that they can scale up production, we would keep having decline, which would end up being a serious global food security crisis in the long run. And not just in Africa, even in Latin America. So I just wanted to put that. It's something Tony should keep thinking about in strategy, how to try to de-risk and ensure the producers have access to the financing to scale up their production. And you can imagine big companies who have processing plants, they keep building processing plants that can grind commodities, soft commodities within 2 minutes, 10 minutes, but the bedrock of the feedstock they use, they don't have access to even education, modern technology. So there's always going to be that mismatch. And in 20 years, we might not have these commodities again. And all those assets you finance today, the processing plants, they will become idle. So I just wanted to put that. Thank you.
Thank you. Very good comment, and of course should be taken into account, into consideration when we talk with banks and when we talk especially with governments. Thank you very much all.